Whirlpool shares are getting a slight boost today, despite the company posting mixed second quarter earnings, citing a $346 million hit on the back of its exit from Russia. The home appliance company slashed its full-year profit outlook as record inflation and supply chain constraints weighs on sales. Joining us now to discuss is Whirlpool CFO Jim Peters. Jim, always nice to see you. I was just on the earnings call, and you guys said we do assume a recessionary environment around us, and you went on to talk about how you've pulled out your recession playbook. I didn't hear this from you guys 3 months ago. How bad have things gone out there?
Well, here's what I would say, and you know, all year long we've started to see demand begin to come down a little bit, both in the U.S. and in our international markets. I'd say what we saw in the second quarter is it just confirmed that it's probably more than a short-term dip. And so that's why on the call today, Mark started talking about our recession playbook. But really what it is if you look at our second quarter earnings, and we had 9% EBIT margins, which are well above what our pre-COVID levels were, despite the fact that you have record inflation and you have the industry down right now year to date. And what we've been able to do is one, manage our cost environment as best we can. And we talked about that, that means as we go into the back half of the year, we'll take more cost cutting measures to offset some of that. Two, it's managing our factories and the capacity and making sure that we aren't building additional inventory. But it also gives us an opportunity, if you think about during COVID, with the supply chain constraints we dealt with and other manufacturers dealt with, we were paying premiums to try and get parts in and components in as fast as we can. And now you can begin to, balance that out a little bit more and not spend as much on those premiums. So, those are the kind of things that we were talking about. But, as I mentioned, what we saw it at the beginning of the year and knew we needed to start to prepare. But in the second quarter, it really confirmed for us that it's probably going to last throughout 2022. Now, from a long-term demand perspective, though, we're very bullish. And we still do believe between replacement industry and the need for additional housing, especially in the U.S., the industry will do well, on a long-term perspective. But we're preparing in the short term to deal with the demand slowdown.
Jim, when I hear the two words recession playbook, I think Whirlpool is now going to slow the pace on hiring, perhaps cut production. Is that right, or is that correct?
No, that would be correct. I mean, the first thing we did say is we are slowing down some of our hiring and just being, very diligent in that process and saying, okay, what are the needs right now? What are the priorities we want to invest in? And then from a production perspective, as I mentioned before, it's really about managing your inventory levels or your supply to the demand that's in the market. And if you look back historically, we've been relatively good at doing that. And so, these are the things that we learned, whether it was in the financial crisis or in the early stages of the COVID pandemic or whatever, the things that we need to apply. And we're just applying those quickly to make sure as we head into any type of recessionary environment, we are well prepared and are set up well.
Jim, it's Julie here. There's one analyst this morning over at RBC who said that the downgrade to the earnings per share forecast for the year is a, quote, tug on a needed Band-Aid rip. Now, to be fair, he hasn't underperformed on the shares, so he's seeing it through that prism. But what is the risk that you guys are going to have to further downgrade your forecast, that you're going to have to, as we know, the situation has defied most of corporate America's expectations. We saw that from Walmart, right? So how are you managing your and investors' expectations?
Well, I think if you look at our business historically, the second half of the year is typically stronger than the first. With the guidance that we put out there right now, it would say that the second half is just very slightly better than the first half. So part of what we've got is we've got 2 quarters under our belt, and we've got good visibility, obviously, into the third quarter and somewhat into the fourth quarter right now, which gives us more confidence in terms of the estimates that we're able to give. And as I mentioned, we did adjust down this quarter just to reflect what we think the environment will do for the rest of the year in terms of demand. Additionally, the thing that you have to take into account there, as I mentioned, on some of the actions we're taking to as we look at a recessionary environment from a cost perspective, those weren't originally planned at the beginning of the year. And so while demand is weaker than we thought, we are beginning to take cost actions that we hadn't planned to take necessarily to help offset some of that. And so, I did read that report. Now, I do think, the other thing that was missing there was that our North America business still has extremely strong margins. And if you think about our company as a whole, that's a big part of it. And, looking at the over 14% margins we saw within this quarter, I think you should expect to see similar margins throughout the remainder of the year, which will allow us to hit the guidance that we put out there.
And what about in the rest of the world, where it's likely that a recession is already being incurred or experienced even as we speak, whether that be in Europe or whether that even be perhaps in some parts of the Greater China region in Asia, as you kind of round out the net sales for that region too?
Yeah, well, I'd say we've been seeing it for a while in EMEA, and part of that is you have to take as the war happened in the Ukraine, and obviously there was a slowdown in our Russia business associated with that, and then a broader European slowdown. We've been dealing with that already from early this year and preparing for that. And I think, we have that factored in pretty well right now. Asia, actually, because we don't have the same presence we had in China before, it's more based on our India business. Year over year, we are seeing growth because, remember, they were in a lot of COVID lockdowns last year. And so while the growth is not to pre-pandemic levels, we still are seeing year over year growth there. I'd say that part of the world we've been dealing with the strongest decline for an extended period of time here has been Latin America. And the markets have been down significantly, double digits in both Brazil and Mexico for multiple quarters now. And despite that, if you look at our Latin America margins, they've still held up really well. And some of that is we're able to take pricing to offset a lot of the commodity costs, but then they've managed their costs within their business and especially their fixed costs very well. So to your point, we've actually been seeing this for a while in areas outside the U.S. and dealing with it pretty well as far as we're concerned.
Jim, has inflation peaked in your business?
We said today that, listen, I think there's some areas where we saw it peak in Q2 and Q3 is where we expect the remainder of it to see the peak in the remainder. And if you think about some of our commodities such as steel, we're probably, nearing and coming off or, right around the peak there. Oil obviously went up and then is leveled off and stayed at a little bit lower level, which drives some of our input costs around, resins and other things. And transportation costs also, I think, we saw a peak in Q2, but then we did see some opportunities where the costs had gone down slightly. So again, all those right now, what we're looking at is by the end of Q3, we do expect to be to probably a peak environment.
Jim? Good to see you. Thanks so much for being here, walking us through your numbers. Jim Peters, Whirlpool Corporation CFO. Thanks again.
And inflation is not just the domestic story, it's also part of the global growth story. Another news headline that crossed this morning, the International Monetary Fund painting a grim picture for 2022 as it again slashes its forecast, now projecting 3.2% growth this year. That's a noticeable downgrade from its previous projections. And the big reason, global inflation. The IMF expecting that prices this year will rise 6.6% in advanced economies and 9.5% in emerging market and developing economies. Here with more on that report is the IMF chief economist, Pierre-Olivier Gourinchas, joining us live on the program. Great to have you on the program. Just walk us through a little bit more exactly what the weight is of global inflation on the forecast, a noticeable downgrade from the last round of forecasts in April. How worried are you about global inflation tipping us into a global recession, perhaps?
Well, good morning. And you're right. I mean, pushing inflation has been one of the three factors we've highlighted behind the downward revision in our projections update. And the way inflation plays out here is that it's eroding purchasing power for consumers and households. And so that's leading to less demand. But it's also affecting their views on the outlook. It's creating uncertainty. It can increase their sense that maybe the future is less certain, is less secure. And it leads central banks, as we've seen the Fed doing in central banks around the world, really pretty much in every country maybe except China and Japan, to tighten monetary policy. And that tightening of monetary policy is also going to slow down economic activity. So that's one of the three main drivers of our revision.
So let's break down some of what we're seeing, where we're seeing that inflation come through from. Obviously, energy, a big one that we've been watching very closely. When you look at a place like Europe, there's still a lot of questions clouding the outlook there about what that supply is going to look like, both on oil as well as natural gas. How do you assess how significant a headwind that's likely to be as we look into next year?
Well, in the European context, this is where the second factor is playing out, and this is the impact, the continued impact of the Russian invasion of Ukraine and the impact it has on energy markets. And so we're revising down also our growth projections for the euro area, especially in 2023. In fact, in 2023, we are projecting that growth will slow down to about 1.2% for the euro area. But we're also flagging that there are important risks to the downside related to the supply of gas from Russia to the euro area. And if we were in a scenario where those Russian gas flows to Europe are fully shut down, then there would be another layer, if you want, in terms of the downward revision, and we're anticipating that it would knock off another roughly 0.8 percentage point of economic activity in the area. So this is sort of the second major factor that leads us to revise our projection is the slowdown we see in the euro area related to the impact of the war.
Well, as a follow-up, I want to ask about the central bank policies around all of these headwinds. When we talk about, for example, the European Central Bank hiking rates last week, the Federal Reserve having an important meeting tomorrow where they're also expected to raise interest rates, that's all supposed to get prices down. But as you just outlined, a lot of the price increases are due to something that's completely out of the central bank control, which is what's happening over in Eastern Europe. So do you worry about a central bank policy mistake here and hard landings, not just in the United States, but in other parts of the world as well?
Well, look, there are different sources behind the inflation numbers that we're seeing right now. And certainly, there are things related to energy and high oil prices and gas prices, for instance. But there are also, and supply chain disruptions, there are also demand factors. The fact that a lot of households came out from the pandemic with excess savings, what we call excess savings. They may not be seen as excess savings from the perspective of these households. So we have a combination of factors. But let's step back and think about where we were in terms of monetary policy back at the end of 2021. Conditions were extremely accommodating because central banks were trying to support their economies during the pandemic. And so it's only natural that at the very least we remove that level of support when we're moving away from the pandemic. And at the same time, we're facing these extremely high levels of inflation. So central banks have to tighten. They don't really have a choice at this point, regardless of where inflation is coming from. And we actually look at what a number of them are doing, and we think that this is more or less appropriate given the environment.
So they don't really have a choice here. Now, does that mean that emerging market central banks also don't have a choice here? We're seeing a strong dollar weighing around the world. I mean, this is raising perhaps some chatter of, could we see a 1994 like Mexican peso crisis? Could we see a 1997 like Asian financial crisis again, as some of these countries maybe have difficulty dealing with a devaluing currency domestically? Do you see that as an issue as well?
We certainly see a lot of financial tightening around the world, and it is having a serious effect on emerging markets. We see, as you mentioned, we see the strength of the US dollar. That's actually implying more inflation in a number of countries because they import goods that are invoiced in dollars, and so they see higher prices for these goods. It makes it harder to service dollar debt. We're seeing capital flow out of these countries, emerging market economies in particular, and we're seeing spreads increase. So all of this is adding to the pressure. At the same time, we are not seeing disorderly market conditions right now in the EM space. What we are seeing is a number of countries that have actually improved their policy framework, the way they conduct their monetary policy, the way they manage their exchange rate, let it adjust when conditions change, as we've seen, the way they try to use their instruments that they have at their disposal to protect their financial sector, to prevent banking meltdown and the financial sector panic. And so far, we haven't seen really any disorderly response in financial markets. So I want to say, yes, there is tightening. Yes, there is pressure. But as of now, we are not seeing anything like the taper tantrum of 2013 or the Asian financial crisis or even the Mexican crisis of 94-95.
Let's talk specifically about China. You're projecting growth of 3.3%. That is well off the 5.5% that the government had set for itself this year. Obviously, the zero COVID policy playing into some of that as well. But I wonder, when you look at some of the headwinds, the risk factors in China, what concerns you the most? And we've been also watching what's been playing out in the property markets really closely. It sort of feels like the government is reversing its policy to really double down on some of that debt they were trying to slim back on because of where the economy is right now.
Yes, there's been that's the third sort of factor leading to our downward revision is China. And, you know, when you put it all together, the U.S., the euro area and China, the three largest economies in the world, being revised down. This is what leads us to our gloomy outlook, if you want. But on China specifically, we are projecting 3.1% growth in 2022. And just as a point of reference, this is the lowest growth number since 1976 in China outside of the pandemic. So this is really something that is big news. And it's on the back of, as you pointed out, the COVID-19 outbreaks and lockdowns that we've seen in the first and second quarter, and also the slowdown in terms of the real estate sector. So looking forward, the good news about China is that it has a lot of policy space and it's not facing very strong inflation pressures. So it can remain more accommodating in terms of its policy stance. And in particular, fiscal policy can play a role to try to support the economy, and in particular, vulnerable households that might be suffering in the current environment. So we're seeing that there's room for China's sort of rebound in the second half of the year and in 2023.
And if we shift over to the United States, I mean, they had a pretty swift downgrade in this report compared to the April projections. Does that imply that you see a higher risk of a hard landing here in the United States?
Well, the way we would characterize it is that under our baseline projections, there is a narrower path. The growth is, as you show on your screen, is projected at 2.3% in 2022. Then we're expecting a slowdown on the back of this tightening of monetary policy and also in the context of still elevated inflation to about 1%. But the Q4 on Q4 growth in 2023 for the US is estimated at about 0.6% in our projections. And 0.6% is a low number. It wouldn't take much of a downside, a materialization of a downside risk to sort of knock off the US from having positive growth. So we're seeing a very narrow path going forward, not necessarily a recession under the baseline, but certainly a very vulnerable situation.
Certainly a lot of layers to all of this. IMF Chief Economist Pierre-Olivier Gourinchas, it's good to have your time today. Appreciate you stopping by.
Well, crypto also tracking the equity market declines today. We saw Bitcoin falling below 21,000, still in that holding pattern of the low 20s. But one name that keeps popping up as we see consolidation in this space, and that's FTX. Well, FTX founder and CEO Sam Bankman Fried is joining us now, along with Yahoo Finance's very own Dave Hollerith. So, Sam, you seem to be on a tear lately when it comes to deal making, most recently with South Korea's Bithumb. And of course, media reports link you to any crypto exchange that appears to be struggling. So first, what's the strategy with Bithumb and what's the criteria that you're using when you're picking your acquisitions right now?
So, when we're looking at the acquisitions, there are a few different, theories behind them. Some of these, and I think that you can look at the borrowed lending platforms that we interface with, are primarily about bailouts, or primarily about kind of buttressing the capital that these places have in order to protect consumers and to make sure there isn't contagion spreading through the ecosystem. That was certainly the reason that we started looking at Celsius, at BlockFi, at Voyager, and ultimately the reason we ended up sort of moving forward with Voyager, with BlockFi rather, on that respect, was because they had good risk management processes that had put them in a place where they were able, with a bit more cash on their balance sheet, to move forward in a strong direction. That's sort of one type. The other type that we look at is about expanding what our business is. And we tend to not view these as tech acquisitions so much. Some of these are looking at the regulatory side, some of these are looking at the customer base side, and some of these are really international expansion sides. And then, of course, there's Storybook for All, Good Luck Games, which is a little bit of a different story, which was a totally new industry that we wanted to explore interfacing with.
Yeah, Sam, I wanted to get on sort of the other side of that, which is the Voyager joint proposal that FTX and company put out on Friday, and it's since been rejected. But I was just curious, what was the idea behind that proposal, and is the deal dead?
So, yeah, it's a good question. And, the deal isn't necessarily dead. Like, ultimately, shareholders will get to decide what they want to move forward with. And I don't think we've seen sort of the final story on that side. We don't know for sure what will end up happening. But the philosophy behind it basically was, look, like, bankruptcy proceedings suck. They suck for everyone. They're really unpleasant. And customers end up getting screwed. in a number of ways. One is just like by the time bankruptcy is over, a lot has been drained from the funds in the first place by the legal process. A second is that it just takes forever for customers to actually get their funds back. And a third, to sort of pile on to all of that, is that, in the end, you just don't actually have what you think you have sometimes coming out of these bankruptcy proceedings, where, if the asset prices move, customers can be exposed to that and actually end up with whichever is worse, what it was, trading at the beginning and it was trading at the end of the bankruptcy proceedings. Those are all reasons that this can be a really unpleasant process for customers. And, the core thing that we were thinking about is how can we just make this as clean as possible for users and just not worry so much about, trying to make money off of it or anything like that. That was explicitly something we were trying to avoid. With our offer, it was just like, what's the cleanest, quickest thing we can do here for customers? And that was basically, look, all the assets that remain with Voyager, we'll give them out to the customers pro rata, no nonsense. And we'll do that as soon as possible. We're just like ready to move on that, if and when the proposal would get accepted. And we even just made it non-binding. So if customers, even if that proposal were in general accepted, proposals could, customers could decide they don't want to do this. They want to go through, the longer bankruptcy process. And look, if that's what they want, that's fine with us. We don't want to be prescriptive about this, but we wanted to give them a more direct option.
Hey, Sam, with these recent acquisitions, you, FTX, are getting more and more control of this industry. I think it's a troubling thought for some people out there when they look at and they believe in the decentralization of crypto. And that's one of the most attractive parts of this industry to them. What do you say to that? Some of the critics out there that are saying, hey, you're simply getting a bit too big, or you're getting a little bit too large here for this space for just to have FTX to control.
My basic response is, look, on a lot of these deals, a lot of these bailouts, we reached out to everyone we could in the industry and said, hey, do you want to come in this with us? Do you want to do it yourself? Like, we'd love someone else to take this on. And we don't want to be the only ones doing this. We want this to be a broader, industry effort. In the end, the response we got from sort of other investors was basically, wait a minute, some of these companies look like they might have some financial troubles. Or so like, yes, that's correct. That's why they need help right now. Like, I don't know what you're expecting. But most people just didn't want to move on it because of that. It wasn't what they viewed, their role in the ecosystem to be. They wanted to do like really safe, sound, high upside investments and not sort of like, investments that might lose. So we would love there to be more people involved in this. I think that would be great. We'd love other people to step up. That sort of didn't happen very much. And we think the single most important thing is that we do backstop the industry, and that is paramount. And, we'll do what it takes to do that. But yeah, ideally, other people would be joining in that with us.
So Sam, though, at least for right now, you do seem to be considered the sort of the bank of last resort for a lot of these struggling crypto companies. But how long can that last? How long can you keep bailing out some of these companies in terms of how much funding there is available to really keep propping the industry up?
Yeah, it's a good question. We obviously have to be conscious of that, right? And sometimes when we end up passing on one of these, right, when we end up deciding there's not really much we can do, a lot of the context often is, we know we don't have infinite ammo, right? We have to be like smart about how we use it, and we don't want to flush billions down the drain on one hopeless endeavor. Like a few billion is ballpark the amount that, we have to operate with here. And so, we can't bail out an infinite amount here, but we can do a non-trivial amount. We have done some, and we're making sure to keep enough in reserve that we could do more. If there, came a point where it was really valuable and important, and or urgent to do so. But yeah, it's not infinite. And, we would really love other people to come in and sort of like, help add to this pool of resources.
And Sam, obviously, it's a huge week in business. We have, big tech earnings, the FOMC, and then obviously the GDP coming out. And I'm just curious, in terms of what seems like the most impactful thing for the crypto market. Like, what are you paying attention to this week?
It's a good question, and part of the answer, honestly, is that things have become pretty correlated in a lot of ways. And I don't necessarily want to say that's a great thing, but it is, I think, a true thing. And more specifically on that, we've seen the market get to a position where really what's driving all of this is, expectations about future inflation or lack thereof, right? And when you see market movements, a lot of what's happening is that there's been a shift in sentiment about whether monetary supply is going to be increasing or decreasing. And that's all coming from how will the Fed respond to these numbers coming out. So there's a first order impact of like how are earnings, and that will matter. But what's going to matter much more, frankly, is the read through from those earnings and from FOMC and other things to expectations about whether fiscal and monetary policy is going to continue tightening or is going to start signaling that it has done everything it needs to do and that, they're in a more stable place going forward. That's what I'm looking for the most is the Fed's reaction and frankly, Congress's reaction to these earnings rather than the earnings themselves.
So Sam, say tomorrow we do get a 75 basis point hike. That's largely what is expected on the street, but inflation doesn't get under control and the Fed is forced to be a bit more aggressive than we maybe initially thought in the fall. What does that mean for crypto?
I mean, that's going to be a decrease in all risk asset prices, including crypto, most likely. Obviously not investment advice, and who knows for sure exactly what's going to happen. But, my strong suspicion there is that you're going to look at everything that's being priced versus the US dollar right now, and that includes crypto. That also includes stocks. And you're going to see those prices fall versus the dollar, or really what you're going to see is the dollar rise against risk asset prices on the expectation that monetary supply will further tighten because of the Fed feeling like they have to further reduce monetary supply in response to persistent inflation. On the flip side, if you see inflation look like it's starting to fall, you may see the Fed start to back off a little bit and say that they don't need to tighten more. That would signal a relative increase in monetary supply, decrease in the value of the dollar, and increase in risk asset prices, including crypto.
Yeah, on that note, just outside of the macro, cryptocurrency, for a lot of cryptocurrency advocates and investors, they want to see, more usage, obviously, of it, not just necessarily of Bitcoin, not just trading like a tech stock or something like that. So, what kind of events are you paying attention to in the near future? I mean, the Ethereum merge seems like an obvious one, but for usage.
Yeah, it's a really good point. And right now we're seeing high correlations because a lot of what's happening is, things coming out of the Fed is, information about expected interest rates and US dollar supply, and those are dollar moves. But things that are going to be most important long-term are, the underlying technology and use cases. And, what's sort of like biggest and most important there, I think basically what we're looking at is where is this going to see adoption first? I think the ETH merge is going to matter. I think more generally, blockchain scaling matters a lot, right? Do the fastest blockchain succeed in getting to a million transactions per second? That's going to be a key thing to watch, because if they do, they're at the point where they could support global payments networks, global social media networks, global markets. If they fail to scale, that's going to limit the amount of adoption that they could get. That's going to be one thing. And then whether we start to see enough adoption that payments could plausibly happen over it, that both the buyer and the seller in a transaction might be using crypto. That's the second thing. And the third thing that I'll say is regulatory clarity in the United States. Huge thing for the industry, huge thing for protecting customers, and also a huge thing for allowing the industry to move onshore. And, I expect updates on that over the next 6 months as well. And I'm optimistic about that.
Certainly lots to watch, and hopefully some of those transaction fees end up going down as well. A big thank you to Sam Bankman-Fried there and our very own Dave Hollerith. Thank you both so much.
Seeing the bulls eat up shares of Chipotle today, I should say devouring, after the Burrito King revealed a better than expected quarter. But the company did warn that sales slowed down a touch to kick off the third quarter as consumers pinch pennies with recession fears mounting. Let's dive in here with friend of the show and Chipotle CFO Jack Hartung. Jack, good to see you here. I think the market's locking in on what you said about pricing. Taking another price increase in August, how much is that increase, and do you think consumers will start to push back a bit?
Yeah, we're looking at about a 4% price increase in August, Brian. And listen, inflation continues. And, what we're seeing is the next wave that we're going to see into the third quarter is going to involve beef, dairy, packaging. And we're still seeing waves of wage pressure as well. We took that big increase where we took our wages up more than 15% over a year ago. That brought our wages to a $15 an hour average wage. But we're still seeing pockets where we have to increase wages beyond that as well. So inflation is here to stay, or at least for a while it's here to stay. The good news is we have pricing power. And so we have the ability to raise prices. That's not what we love to do. But when the inflation keeps coming at us and it doesn't look like it's going to abate in the near future, we will have to take price from time to time.
As I mentioned at the top, Jack, consumers are in a tough spot right now, especially lower income consumers. Have you started to just parse your data to see who is coming into the restaurants and who is buying what and who is not buying it?
Yeah, when we stratify our customer base, we did see a slight slowdown during the quarter. We're really seeing our upper income consumers, those at $75,000 or more, have not changed their buying habits. They're coming just as often, if not more often, and they're spending just as much, if not more. Where we're seeing a little softness is under $75,000, and it's understandable. I mean, when you're paying double or near double for gas, compared to what you paid last year. Vacations are more expensive, groceries are more expensive, everything's more expensive. At some point, the consumer has to pull back a little bit, and it's unfortunate that we are seeing that. Luckily, our consumer base does skew towards more upper income consumers. About 60% of our customers are in that $75,000 and higher income bracket.
Jack, to your point, I mean, I've even pulled back some of the levels of spend, not just at Chipotle, but around a lot of the lunch or dinner experiences, especially in cities like New York. But when you think about the different cities and the different pricing mechanisms that you have to your advantage, what do you kind of look out to in the future to say that the customer can either continue to take on costs in one part of the menu, or whether you're going to actually, and they were able to pull how much I spent pre-2022 versus during 2022. Look, I've pulled back a little bit here. So, what are you looking at within the customer to define exactly where they're going to be able to continue to take on costs?
Yeah, the main thing that we look at is what is a Chipotle meal, what does it cost compared to other competitors? And when we look at Chipotle compared to others in the fast casual, sector, we're still underpriced. Every competitor we look at, whether they're in the Mexican category or they're in the salads, but they have a food ethos, they're much, much, much more expensive. Even after this price increase, you can get a chicken burrito. More than half of our customers get a chicken burrito or chicken bowl for around $9. Now, that's on average. In New York, it's going to be more. In the middle of the country, it's going to be less. But on average, it's still going to be around $9. It's really hard to find a meal anywhere in fast casual for less than 10. It's getting harder to find a quality meal with real ingredients like you find at Chipotle and real culinary like you might find at Chipotle for less than $12 or $13. So that's the thing that tells us we're still underpriced based on the culinary we provide, the food with integrity we provide, the customization, and then the speed, whether you're coming through our digital channel or you're coming in the restaurant, and we provide great throughput. So that's the main thing we look at to make sure that the meal we provide at Chipotle is still a delicious meal that our customers love and at an affordable price compared to any other alternative.
I always find it fascinating to get an update on the rewards members. You've got over 29 million. I believe that's 1 million net add during this most recent quarter since the last time we checked in with you, at least at about 28 million. And so with regard to that, what are you noticing in the spend levels from those rewards members? Are they spending higher, or are they being driven by some of the menu innovation items that get added onto the menu?
Yeah, well, listen, our customers that are in loyalty, they come more often, they spend more. And I'm not just talking about them joining the program because they're already a frequent customer. After they join, even frequent customers come more often. After they join, even medium frequency customers come more often, and they tend to spend more. Now, there are a few cohorts within that group. And again, it would be more the lower income cohorts, who have pulled back a little bit. But as a group, the loyalty members, they do love trying our new menu items. They love coming more often. The more they come to Chipotle, the more we have a personalized message to them where they learn more about new menu items. In fact, one of the things we're doing with every loyalty member on National Avocado Day, they're going to be able to buy either guacamole or queso for just 1 penny. So there are rewards like that where we'll surprise and delight to make sure our customers love being part of the program and love coming back to Chipotle.
Jack, I want to highlight something you guys said on the conference call last night. You said, quote, "We are exploring an automated real-time kitchen production system." Now, I know you guys to cut all your vegetables, cut all your meat, and grill it accordingly. I mean, are you going to start turning these locations into scary-looking McDonald's internally just to meet the demand you're seeing?
No. Rest assured, we still value real culinary. We still value real ingredients coming in, so whole onions, whole avocados. mashing by hand. But there are some tasks in the restaurant that, our crews just don't love doing. And, one of the things we're experimenting with is a automation called Chippy, and it will automatically fry our chips. Frying the chips, it's really hot. I mean, the crew is standing above a hot fryer for a number of hours to fry these chips. And so if we can take a task like that and bring automation along with the employee experience, it makes the employee experience better. They can focus on other culinary in the restaurant. They can focus on customer service related items like that. But the easier choice, Brian, that would have compromised our culinary, we won't do, is we could have the chips made offsite and then brought in a bag. We won't do that, but we will look for automation that's going to allow us to continue to make fresh food in the restaurant and then enhance the employee experience.
All right, going to have some up in arms employees if Chippy starts winning Employee of the Month out there, Jack. Chipotle CFO Jack Hartung, thanks so much for joining us here today. Appreciate it. Let's continue this conversation now with Barbara Humpton, who is the president and CEO of Siemens USA. This obviously a massive effort in order to move forward the broader chips and semiconductor industry. What are your expectations in terms of not just what we'll see next, but what kind of capacity and production may be unlocked if this fully goes through?
Yeah, Brad, first of all, we're thrilled to see the CHIPS Act moving. This is something we've been supporting for quite some time now, with the recognition that this technology is key to America's future leadership in the world economy. You see, we're entering a new era for manufacturing, and it's taking shape right here in America, where manufacturing is more digital than ever, and where advanced manufacturing technology makes everything possible. We think about digital twins, automation, virtual reality, augmented reality. All of these technologies go into the electric vehicles, the smart buildings, and even, as we heard from Chipotle, the chip machines that we'll be using in our everyday life. So truly, global innovation is essential, but making things locally is now key to our overall security and our productivity. The disrupted supply chains we've seen really show the need to establish local production and be resilient against future disruptions. So the CHIPS Act, both in its the investment it will make in new manufacturing capacity, as well as the investment it will make in research and development, are both going to be essential to establishing America's leadership position for this next decade.
Barbara, fortunately, there has been no shortage in Chipotle salad bowls because I just want to be in a good mood. So I'm glad that has not happened. But look, over the past year, looking back on the chip shortage, how has that impacted your business and what has it prevented you from doing?
Well, I think all businesses have been really struggling with the semiconductor supply because, as we say, it's in everything. An EV uses some 2,000 chips. And in order to build an electric vehicle, manufacturers are looking to automation that Siemens provides. They're looking to the electric vehicle charging stations that Siemens provide, both of which use semiconductors. And so what we've done, our heroes in supply chain management here in the corporation have been using analytical tools, market tools to look out and use intelligence to understand where there may be pinch points in the supply chain. One of the key tools they've been using is transparency into our own operations, aggregating our need across businesses, making sure that when we communicate with semiconductor providers, they can trust us, that we have a real need and that we will be using all of the supplies they make available to us. What we're moving into now is the ability to actually use predictive tools to be able to look into the future. So with all that, I guess the underlying message, Brian, is the ability to use technology that is readily available to us today, get into that digital realm itself, and use that to help us manage the flow of product to where it can be best used.
What are you hearing from your customers in terms of how they're going to be navigating, even in the absence of a CHIPS Act in this interim period where it's looking to go through fully, and where there is more capacity that's looking to come online? How are they navigating just this interim period, and what are they asking more from Siemens?
Yeah, in this interim period, what we've known is that we need to be in very close contact with our customers, because what a lot of people don't understand is that we at Siemens are in all parts of the semiconductor supply chain. When Intel chooses to build a new location, then we could well be the providers of the electricity that will make their production possible. We provide automation that's used within the production factory itself. We also provide the design tools, the software that helps their engineers envision and then ultimately design and ready for production the semiconductors themselves. And as I say, ultimately, we are end users of the product. So the most important thing for all of us in this moment of disruption is clear communication. And as you know, this has been a very competitive field where people have been reluctant to share too much about what their requirements are and what their plans are for the future. The disruption, and particularly with the leadership of the Department of Commerce, we've seen unprecedented communication about where the needs are and how we drive through the bottlenecks today.
Barbara, a lot of manufacturing executives have told us recently they have dusted off their recession playbook. Do you have one of those, and how are you preparing for the slowdown?
Yeah, I think we're all recognizing that, what we're entering right now is a very difficult period, especially with the disruption due to war in Europe, the effects that's having on global energy supply. People are characterizing what we're entering as a global energy crisis. I will tell you that here in the US, my perspective is that we have relative energy security, we have relative health. While many parts of the world are still dealing with pandemic shutdowns, et cetera. So we actually have an obligation to outperform. I was just on a call this morning with Siemens global leaders, regions from around the world gathered, and this message of let's overdrive right now in order to be sure we'll be well prepared for this coming winter. And then one piece of good news is that backlogs are strong at Siemens. And so the number one thing we have to be focused on is relieving those delivery cycle times so that other customers of ours who are going to be critical throughout a long, tough winter are going to be able to perform well.
Some good news. We'll take it. Barbara Humpton, President and CEO of Siemens USA. Always good to see you. We'll talk to you soon.
Persistently high inflation weighing heavily on shoppers, with many families expected to cut back on spending to cover the costs of back-to-school materials for their children as we get a little bit closer to the start of school again. The U.S. chief economist Jared Bernstein from the White House saying, from their view, spending remains strong. Take a listen to what he said earlier.
There's no question that unacceptably high inflation, as the president continuously presses on that point, is upon the land and really discomforting to family budgets. But the key is, how are jobs faring? How's the labor market faring? How's consumer spending? All of those remain in solid territory, and that is a very important backdrop, a tailwind in an economy with, as you've correctly pointed out, has significant headwinds as well.
Significant headwinds. So will that weigh down on the back-to-school season? Let's bring in the National Retail Federation's president and CEO, Matthew Shea, on the show. Great to have you on the program, Matthew. Give us the preview of the back-to-school spending season. It's usually a very important season economically. But again, this inflationary environment may be incentivizing some families to make some trade-offs here.
Yeah, Brian, it's nice to see you. I think, similar to what you just heard in the previous clip with Jared, we're seeing in our research, our conversations with consumers, our surveys, that consumers and American households are doing really what they've been doing since we got into COVID more than 2 years ago, which is they're prioritizing essential spending and they're changing their spending patterns and evolving their behavior to meet the environment. And in the current environment, we have persistent, unacceptably high inflation across virtually all categories, but certainly especially in energy and food prices. And so we're seeing households prioritize things like, in this case, back to school, and treating that as an essential category. And so therefore shifting some of their spending out of other discretionary categories to make sure they can take care of the things that are most in demand. And in this case, that means taking care of their kids, their elementary, high school, and college students going back to school.
Matthew, I guess the question on that front is, what is considered essential in back to school? And we've heard from a number of retailers. This week it was Walmart saying that increasingly they're seeing their consumers sort of trade down. They're focusing on things like food, not spending as much on clothes. I mean, back to school runs the gamut here. Do you anticipate that families will try to cut costs in some parts where maybe they would have spent a lot come fall?
Well, you referenced the remarks, and I know what Doug McMillan said about what they're seeing is that back to school looks like a pretty positive area for them. And so I think, obviously different families make different choices and prioritize different sorts of things, but back to school, back to class spending as a category, broadly speaking, is over $100 billion between back to school and which we define as elementary, high school, and back to college, which is about 2/3 of that spend. And so some of it's going to be in electronics, some of that's going to be in backpacks, books, apparel. It just depends on that household and that family. And I think we'll see people trade out of higher priced goods into goods that are priced to fit their budgets. And we'll see households trade out of other discretionary items to get into the things that they determine to be essential for this particular back to school season, whatever that may be. And I think that includes everything from apparel and footwear and accessories to electronics, furniture, really runs the gamut.
Matthew, I'm not going to ask you about the specific supply chain issues with, pencil boxes or binders or what have you. But broadly speaking, is that as big of a story in 2022 as it was in 2021, knowing that you had a lot of shoppers saying, I'm going to try to go to the store a little bit earlier than normal because I want to make sure that I can actually get the supplies that I need to have my kids ready?
Yeah, I think we have seen an improvement in the functioning of the supply chain over the past several months. I think there's a general sense that some of the backlogs are getting sorted out for a variety of reasons that include the kinds of steps that we're taking here in the U.S., as well as improvements and sort of changes in the COVID environment and workforce patterns in other markets from which we import goods. And all of that is, I think something that it's been very clear retailers and their supplier partners have really been focused on over the course of the last almost 30 months, 28 months. So I think the supply chain issue is getting better. And I think, it's important to remember that the supply chain issue is a byproduct of the demand shock that we dumped into the economy. I mean, the seeds of the current environment were sown 28 months ago when we started to dump almost $10 trillion in fiscal and monetary stimulus into the economy. So the supply chain was functioning fine and well for the economy that existed pre-COVID. What happened was our reaction to COVID impacted the supply chain and not the other way around. Yeah. And I think it's important to keep that in mind.
Matthew, I wonder if we can look beyond back to school into year end. We've talked a lot about how consumer confidence is slowing back. The question is, is the spending going to start to pull back too? What do you see when you look into the all-important holiday season? I know we're months out still, but do you anticipate this sentiment to start to catch up with consumers and how they spend?
Yeah, Akiko, I think the interesting thing, going all the way back to March of 2020, the best indicator and predictor of consumption, consumer behavior, broadly speaking, has not been consumer confidence, has not been the unemployment rate, has not been the amount of the stimulus per se. The best predictor of consumption has been the savings rate and savings and credit and debt ratios that consumers have. And so if you think about it in that context, consumers in U.S. households are still $2.5 trillion ahead of where we were in early 2020 in terms of savings. And so while that's distributed differently, of course, and that's held disproportionately by the higher income households, as long as that holds up, that sustains consumption. And so, the consumer confidence numbers and some of the other things we're seeing they're not irrelevant, but they're not as accurate a predictor of consumption as what the savings looks like. And so as long as we have that $2.5 trillion excess savings over what we had 2.5 years ago, that's delayed consumption, but it's going to perpetuate demand. And so the next few months will be critical, but we still feel like we're on target for 6 or 7% growth during the calendar year and a good holiday season.
Yeah, some important context there in the data that we've been getting. National Retail Federation CEO and President Matthew Shea, appreciate your time today.